Hello, everyone. Thanks for joining us today. On behalf of the Environmental Finance Center Network, welcome to our webinar today focused on using median household income data for water system management. During the webinar today, everyone will be kept on mute to ensure audio quality. If you have a question, please type it into the GoToWebinar question dialog box at any time throughout the session. We will be holding all questions for a Q&A throughout the session and also at the end. We will also be posting the presentation as well as a video recording on our website. And you can reach that website at the bottom left-hand corner URL. That's efcnetwork.org. You will be receiving a follow-up email that includes a link to all of these materials. And lastly, I would like to draw your attention to the handout section on the GoToWebinar control panel. We have 2 documents that are available for you to download and can be accessed under this section at any time throughout the session. We do not submit our webinars to licensing agencies for pre-approval of continuing education credits. We do provide certificates of attendance as a courtesy. It can take 1 to 2 weeks to send out the certificates of attendance, and you must attend this entire 1-hour webinar to receive one. You must have joined this webinar using that unique join link that was emailed to you when you registered, for that's how we count your attendance. Again, we apologize that we cannot guarantee that this webinar will meet requirements for a specific CEU or licensing renewal needs, but if you have any questions about this, you can email us at smallsystems@syr.edu. And for a little bit about us here in the Environmental Finance Center Network, our program provides training and technical assistance to small public water systems in all U.S. states and territories to help those local water systems achieve their goals and stay in compliance with the Safe Drinking Water Act. And here you can see the various centers that make up the Environmental Finance Center Network. You can see that we have centers and partner organizations spread across the entire country for this year's programming. We all work together to create solutions to difficult how-to-pay issues of environmental protection and improvement. And so on that note, to jump right in, I would like to introduce our speaker for today's session. With us today, we have Jean Thompson, a Rural Development Specialist at RCAC, which is also the Environmental Finance Center for Region 10. So Jean, welcome, and I pass everything over to you.
Good morning, everyone, and good afternoon to the others on the east side. I'm coming to you from Lodi, California. Little hazy with smoke and a lot of ash. We got a lot of fires going on today. I am your presenter. I am Jean Thompson. I have been with RCAC now for going on 18 years. I've been a technical assistance provider for nearly 25 years. I've been in the industry for over 30 and have worked with many small systems throughout the U.S. With RCAC, we cover the western states, so I've done work in a lot of the nearby states in California as well as Hawaii. We're going to find out who's in the room with us today. Savannah, if you'll be so kind and launch that poll for me. Just trying to find out if you are an operator, are you a manager, a board member, or an elected official, a technical assistance provider, or a regulatory agency, or maybe you're other. And if you're other, if you want to just put in the chat message box what is your title? Kind of gauging who we have in the room today.
And so we'll leave this poll open for a few more moments here. And we're going to get ready to close this poll in 3, 2, 1. So Jean, are you able to see those results?
I am not.
Okay, so it looks like 79% of folks are from the other category. We have 11% as managers, 3% for board members or elected officials, and 3% for accountants or bookkeepers, and 4% are operators.
Awesome, thank you. It sounds like we've got a good mixture of crowd here, and We'll move forward to our learning objectives. Mainly what my goal is today is to talk to you to help you to understand how the funders are thinking, what they're looking at when it comes to your rates and providing you funding, determining your median household income and how that reflects to the amount of funding that you can receive and the type of funding. And to determine if your community can actually benefit by conducting a median household income or a low moderate income survey, and what those benefits can be to your community. And also how it can develop a stronger capital improvement plan, uh, knowing ahead of time what funding is available to you, what that criteria is going to be, and what your median household income, how that is going to make a difference in the type of funding or the amount of funding that you're going to receive. And then the median household income process. When is the best time to get started? Kind of gauging the length of time it takes to get through one so that you can plan your project accordingly. And then who needs to conduct the income survey? And then how can you get the survey paid for? Is that something you're going to need to pay for and plan for as well? And then at the end, we'll have some question and answers. And then an hour after the presentation, you'll receive an email with the subject title of today's course and an evaluation form. And if you could fill that out, it greatly helps us, and we appreciate getting your feedback as well. Well, this is what we hope as local officials that doesn't happen to us, that our worst nightmare is that we end up on the front local page of our newspaper with allegations of neglect and mismanagement. Here in this situation, the tank actually ruptured, collapsed, and washed out a road, and it was actual cause of fatality. And so I'm hoping by our presentation today, the information I provide you will help prevent you from making the local paper. So part of developing a capital improvement plan or an asset management plan is determining if your system will have the ability to fund reserves to replace your critical infrastructure when it's necessary. And if not, then we need to determine your system's eligibility for funding. What funding is available to you in your state, and what is that criteria to obtain that funding, and how long does it take to get through that process? And remember, debt is costly, so it can increase your service rates. If you can increase your service rates earlier, it can build up those reserves and actually cost you less. This is all part of a capital improvement plan or an asset management plan. Building that strength in your plan is going to help you to be prepared to obtain the funding when it's needed. Also, you may have a new contaminant or regulatory regulation that's coming down the pipe that you need to plan for, and you've already have your rates at a level that's unaffordable to actually pay for the project or the infrastructure improvements. Also, to determine if you determine that you need to increase your rates to build those reserves, or are you going to have to take on debt, or are you going to be able to actually obtain funding to pay for that infrastructure improvements that are necessary? I was working with a community recently that actually qualified as a severely disadvantaged community and was able to obtain 100% grant funding for their project. But the criteria to obtain the funding agency required them to increase their rates to 1.5% of their median household income. So it's really important to know what that median household, the true median household income of your service area, so that we're making that determination. In this case, the 1.5% of the median household income is considered an affordable rate to funders if you are a disadvantaged community or severely disadvantaged. If you don't fall into those categories, then typically they're looking at either anywhere up to 4% of the median household income is considered an affordable rate to your customers. And at that point, they feel once you've reached that level, then they can consider actual providing grant funding to you. Also, if your community qualifies as a disadvantaged or severely disadvantaged community in the past, but the 2020 census is stating they're no longer a disadvantaged community, or if they're using the ACS, which is what we use in California, our funding agencies, to determine that they're actually, that the ACS is actually, the data comes in on an annual basis, so it actually can change. And what I found with a lot of the small systems, the ACS data is actually, and it's American Community Survey, actually comes in at many a times the error, plus and minus error could be anywhere from 15,000 to 18 to 25,000. So in that case, what the data is saying is that your income could be, your median household income could be either higher by that amount or lower of that amount. So in some senses, you may be a disadvantaged community, but the census data is not going to state that. So how can your community benefit from a median household income survey? Well, conducting an income survey tells what the true median household income is of your community or those that you actually serve. Many small rural communities are located, sometimes we have mobile home parks are located in a larger urban area, but that mobile home park actually is an affordable living area for those customers, and they're actually disadvantaged, but the census data is will state that it's not a disadvantaged community. So conducting an income survey can prove that those that you're actually serving are truly disadvantaged. It can open the doors to the community for grant funding, or what we call them grant funding, or forgiveness loans, or low interest loans. So having determining that true median household income is could possibly open those doors for you to obtain those grant funds that you were not eligible for in the prior, based on the census data that's provided. It also helps you determine what's an affordable rate for your community so that you can plan accordingly when you're doing your capital improvement plan or asset management plan. The funders, again, are looking at the median household income. They're looking at the project, the cost of the project, and they're trying to determine if you can increase your rates to that affordable level and still take on debt, and then provide you a portion of grant funding in order to make it affordable for the community and still get the project completed. So by not increasing your rates isn't doing it's not any advantage to the community by not increasing the rates to that level. I always recommend to systems to look at that, determine what that 1.5, if you are a DAC or a severely DAC, that looking at that can determine what that affordable rate is, and you can gradually increase your rates to that level, setting aside the funds in your reserves so that you don't have to take on as much debt. If you don't increase the rates, you determine that you need to go after funding and you've obtained that funding, and the funder is going to look at that median household income and look at your current rates, and they're going to know that you can increase those rates and take on a portion of debt and not be able to get 100% grant for your actual project. Is there a difference between the American Community Survey and the 2020 census? If you can just type in the answer chat message box your answer. Is there a difference between the American Community Survey and the 2020 census?
Thanks, Jean. We have started receiving a ton of replies from attendees indicating yes, that there is a difference between the American Community Survey and the 2020 census.
Well, you're correct. Historically, on the 2010 census, the U.S. only surveyed 1 in every 50 homes. So that means if your community only has 100 residential units that you're serving, only 2 of those homes were actually surveyed. And if those 2 homes are the higher income level of the people within your community, it actually skews what your true median household income is for your community. USDA Rural Development quickly realized coming on the 2010 census that there was a huge disfavor to rural communities. And not only that, they also noticed that it was going to increase the amount of funding that they were going to receive, because the funding they receive to be able to grant or loan to their communities within their state is based on how many disadvantaged communities are within your state. So they came to me, they voiced their concerns that they felt the 2010 census was not going to be accurate and is actually going to eliminate a lot of communities from being able to obtain grant funding or low interest loans. So in California, we decided, in RCAC, decided that we were going to put together a group on a team to work with the state funding agencies to develop a universal income survey guidelines. So conducting a median household income survey under the universal guidelines made communities available for funding for multiple funding agencies and not just one. And this way, if the funding agency is actually paying for the income survey, we're not having to have both funding agencies to provide the funding to conduct the income survey. It's done under one funding agency, but benefiting both and meeting the criteria of both of those funding agencies. So what is the difference between the American Community Survey? Well, it's conducted every month and every year. It also is sent a sample of addresses, and it asks about the topics not on the 2020 census, such as education, employment, and housing, where the 2020 census is conducted every 10 years. It counts every person living in the 50 states and 5 of the U.S. territories, and also asks about age, sex, race, and etc. So that's the difference. They get either the 2020 census is gathering more demographics data, where the American Community Survey is looking more on the income of those within a census block. So I always recommend communities to look at their census data and to track it. What is it saying? And one way you can do that, I provided you an actual handout with a cheat sheet, how to use the United States Census Data website. And this is their actual website. I've just taken a clip of it. And it's, you can see, you simply go into geographic, you go into county, you look at the state, and then they ask what county you're in, and it will pull up the demographics for your county. Not only that, it will actually pull up more demographics data as well as the median household income. So I've provided this to you so that you can do your research, find out if your community is a disadvantaged or has been disadvantaged in the past, and now you're finding the census data is stating that you're not. It's likely that you are disadvantaged and would be worthy to conduct a median household income survey or a low moderate income survey. Up to a poll time again. So do you feel your system would benefit from an income survey? Have you been looking at your census data? Have you been following it and finding that you don't feel that it's an accurate account of what your actual median is of those that you serve in your community?
Great. And we'll leave this poll open for just a few more moments here. And getting ready to close in 3, 2, 1. So Jean, at 52%, attendees have selected yes. 29% comes in next with very likely, and very unlikely and no comes in at 10 and 9%.
Awesome. Thank you so much. Thank you for your participation in those polls as well. We greatly appreciate that. So how is using your median household income a good management tool? Well, when you're setting up a budget for capital improvement planning, we always recommend, and funders typically are wanting a 5-year budget projection. So you're going to look at this 5-year budget projection to determine if you can afford to fund your projects, or are you going to need assistance in order to be able to keep your rates affordable. Funding eligibility is usually determined by the population served and the community's median household income or low moderate income, or the low moderate income or the median household income of those benefiting from the project. So if you're looking at community block grant funding, they're going to look to, and also USD rural development, they're looking at the project area to determine what the median household. So if your project is only going to benefit a 2 or 3 block area, and you feel that 2 or 3 block area is an area that's a disadvantaged portion of your community, it would be worthwhile to conduct a median household income to determine that, so that the funders will so it opens you up to eligibility for grant funding. It's important to know what your median household income is and has been historically, and the ability to monitor your community census data over time. Like I said, in 2010, when the census data came out, many of the systems that were disadvantaged previously were no longer qualified as disadvantaged. In that sense, that would trigger that, okay, if nothing has changed within your community and it's you feel that you're disadvantaged and that then it's worthy to actually conduct a median household income survey. And again, the funders are using that to determine what's an affordable service rate. As I stated, they're going to look at 1.5% of the median household income as to determine what's an affordable rate. And if you're not at that level, they're going to request that you increase rates. In California, we have what we call Prop 218, where we have to actually get approval by our customers to increase rates. So the process can be very timely. And many times what I find with funders is that they're going to require you to go through that rate increase process, or they're going to put it as a condition in your loan or your funding that you sign a resolution to increase those rates in order to be able to obtain the funding. I'm also working with a community. I just did an income survey, actually talked to a community I did an income survey for in 2018 that did not qualify as a disadvantaged, well, they qualified as a disadvantaged community, but they felt that they were severely disadvantaged. In conducting the median household income survey, we determined that they were definitely a severely disadvantaged community, and were able to obtain the matching funds in the form of a grant in order to get 75% of the funding through their FEMA program that they had applied for. If they had not determined that they were severely disadvantaged, they would not have been able to obtain the funds they needed to match the 25% of the project to cover the remaining part of the project. And we're going to lose the 75% of the grant funding that they were going to get from FEMA. So they were able to obtain the 25%, determining that they're severely disadvantaged, and were able to fund a full $4.5 million project with absolutely no cost to the community. It takes time to get through the funding process and to set a schedule to increase rates to the affordability level and to put the funds into a capital reserves. Like I said, it's beneficial ahead of time in your planning to contact the funding agencies, determine what their criteria is, and you can ask them, what census data did they use, and what is their data state? Are you disadvantaged community, or are you not a disadvantaged community? And that's going to help you to know if you're going to need to conduct a median household income survey, and then when do you need to conduct that income survey is critical. Some systems, if they're close enough in the planning and design stage of the project to being a disadvantaged community, a lot of times the funders will go ahead and provide them the grant funding for the planning and design stage. But before they start construction, they'll ask that you conduct a median household income survey in order to determine that you are eligible for a 100% grant for the construction portion of the project as well. And in doing that, it's helping you to plan better for the future, because so many of these funding agencies, especially the state revolving loan fund state programs, typically are going to require that you meet a technical, managerial, and financial capacity in order to obtain funding. So knowing what their criteria is, and if you have to meet those requirements, and that you're doing that in a timely manner so that when you're ready to apply for funding, you understand what the criteria is, what the expectations are of the funder, and that you're prepared to do what you need to in order to meet that criteria. Also, it's useful information to educate the elected officials as well as your customers, and that you've done your homework. You've determined what's eligible to you. You know what portion of the project you may be liable for, and that you can set your rates accordingly in order to set up those reserves that you're going to need to get the project fully constructed. It provides that transparency that's necessary in order to build that trust with your customers as well. And timing is everything. Having all the ducks in the row in order to obtain the funding when it's needed is so critical. I've watched systems take up to 8 years to actually get through all of the criteria necessary in order to actually obtain funding. And this is so typical, and why transparency is so critical in letting them know that you've done your homework and that you know what's needed. Because anytime you're trying to increase rates, it's again, or you're developing that capital improvement plan. This is so typical of communities, customers, is they think it's not flexible. They think it's, oh, it's going to put us in debt in the future, and we're going to have to increase rates. Well, if they understand that the funders are going to require you to increase rates anyway in order to obtain the funding, it's best that they know sooner than later what that criteria is, and that you have no choice that you may have to take on debt, because that's the because of the median household income or where your actual current rates are set at. Capital improvement plans and asset management plans are a flexible document. They should be revisited every year. You need to be looking at those, and also keeping up with the funders' criteria if any of that's changing. Many of them don't. I've not in 30 years noticed much difference. So it's not likely that it's going to change over time, but just knowing what that is so critical. And I'm going to stop just for a second here and check back with you, Savannah, to see if we have any questions in the question box.
We do. So the first question that we received is, as you're talking about rates, are you talking about rates for water and wastewater services combined, or just for water service in respect to the cost?
They're looking at water service respect to the cost, and they'll do the same thing on a wastewater project. In California, we can't commingle those funds. So typically they're going to look at them separately. So if your project's a wastewater project, they're going to look at your wastewater current service rates, and they're going to look at that 1.5%. So and same thing with the drinking water. If it's a drinking water project, they're going to look at the drinking water project, what your current service rates are for that. They're not going to look and consider what your sewer rates are. They're just going to be looking at what your current water rates are and what's affordable.
Great. And then to follow up with that, an attendee asked, how was the 1.5% determined to be the affordable rate?
It's a national standard that's used. I don't know who came up with it, but I noticed it doesn't matter if it's USDA rural development, or if it's the state revolving loan fund programs. Both of them I have found in multiple states. That's a common national standard, is using the 1.5%.
Great. And then lastly, before we move on, an attendee asked if there were any other sources of income data that's available to the public besides the census or ACS survey data, or is this the only source available to the public?
It's the only one that I'm aware of that's available to the public. But I always state, because like some USDA uses different census data. They actually use the 2020 census, where the state revolving loan fund agency uses the ACS. So you just need to know which data that they use. And typically, what I do is just tell the communities to ask the funders. And I don't know if there's if you guys have any type of thing in other states, but in California, we have what we call the coordinating finance committee, California Finance Coordination Committee. And it's where all the funding agencies have actually formed a committee and a form where you could submit your actual project in, provide them as basic information as you can, but as much information as you can. And they actually look at the request, each funder, and they actually respond to you and tell you if you're going to qualify for their funding or not. And I don't know if other states have that, but that's and they have a website that all of their criteria is listed on, which is very helpful. And then they also hold well, now they're doing webinars, but they were holding actual on-site training courses where all the funders were there, where you could actually sit down with them and talk to them about your project and your community, and they would tell you if they felt that you would meet the criteria of their funding. And if not, then you would they would send you over to a different funding agency that they thought would be able to fund your project.
Great, thanks, Jean. So we did receive a few more questions. Would you like me to read them off now or cue them up? All right.
No.
So
All right.
the next one, the next one that was asked is, when you refer to rate change, are these rate increases or rate structure and design, or both?
It could be any of those. I mean, it just depends on what's best for your community. And depending on what state you're in and what you're able to do. When we do rate studies, when we're looking at all different angles to make it fair and equitable to all your ratepayers. So you could be looking at any of those in order to be able to determine what is an adequate rate in order to set aside those reserves that you need to set aside.
Great. And then lastly, right now, an attendee asked is, what would be considered affordable as a proportion of median income for wastewater?
Well, again, what they're going to look at in is they're looking at the residential service rate, because most of these funding agencies are providing the funding to benefit the residential units. And we don't survey commercial. They do not survey vacation homes or secondary homes. And well, my experience has been with the state revolving fund program and also the USDA rural development. If you have 50% or more secondary homeowners, they will not provide grant funding to those systems. So again, really looking at your community and how it's structured. If you have, again, if you've only got a small portion that are primary residents, those primary residents would be the ones that they would survey. But keep in mind, even though you may be severely disadvantaged or disadvantaged community, if majority of your homeowners are secondary homes or vacation homeowners, many a times you're not eligible for grant funding. So it's really pays. That's why I stress so much that you really need to communicate with your funders to find out if you do qualify. Because just because you're disadvantaged doesn't mean you're going to automatically get grant funding.
Great. And that's all that we have received at this time.
Great, thank you. Great questions. And I wanted to answer those questions because we kind of went through how it's valuable to use it as a management tool. Now we're going to kind of dive into that MHA process so that you can understand kind of what that entails. And again, it's you recommend that you first submit some of the funders do require that you submit an approval letter. Submit a letter to them telling them why you feel that the census data is not accurate for your community. And if it's just that your community, the blocks, census blocks are not representative, that's larger than what your actual service area is typically what most systems state when they submit a letter asking for approval to conduct a median household income from the funder. Once you've submitted that letter and they've determined that yes, they approve for you to conduct it, they're going to provide you what they call their income survey guidelines. And USDA rural development has national guidelines. So from state to state, those are typically the same. I don't see any difference in those. They're pretty much, and they do require that you submit a letter. And the reason they're wanting you to submit a letter for approval is they want to determine first if you already qualify as a disadvantaged community and don't need to actually conduct an income survey. Even though you may be a disadvantaged community, if you feel that you've been a severely disadvantaged community in the past and nothing has changed, it may still be worthy to conduct a median household income survey and express that to the funder that you feel that they can, that you would actually qualify as severely disadvantaged, where you could actually qualify for 100% grant. Then it's worthy to discuss that with them, that that you would like to have an income survey conducted for that purpose. So submitting that to them, typically they are going to ask for a map of your service area as well. They want to know, and purpose for that is they're going to look at the census blocks and see if that is the true fact that the blocks are larger and not representative of your actual service area. Once you've obtained those guidelines, you really need to read over them very carefully to make sure that you follow them to the T, because if you don't, they can disqualify the income survey, and you've wasted all of the time and efforts in doing that. And then once you've obtained the guidelines also in there, it will tell you if you have to have a third party, outside, unbiased party to conduct the income survey, or are you able to use community members or community group in order to conduct the income survey. And then they're going to ask for, they're going to tell you what type of survey form you're going to need to use, and some of them also provide template letters. Most of them that I've utilized typically will provide you example, what we call customer letter or introductory letter, and then sample actual survey letters that they want you to use, or what data they want in those letters that you're sending to the customers. And then also the survey form. If you're doing an income survey that includes the Community Development Block Grant. Community Development Block Grant actually uses low moderate income to determine what if you qualify for their funding. USDA Rural Development, they utilize they look at household income, not family income. In CDBG, they're going to look at family. So if there's more than one family living within a household, they're going to ask for each family to complete that income survey. So if you're doing an income survey in combination in order to meet two different funding agencies' guidelines, you need to make sure that your survey form is set up properly in that manner, and that you're collecting the data that's needed to meet both funding agencies' guidelines. So CDBG, they do look at the number of people that live in the home and then what the family's income is. And then they use the HUD by county. They utilize what the survey data states for that county And based upon the number of people living in that home, they have a specific criteria that states if you're considered a low moderate income. And then it's the percentage. You have to have over 50% of the people within your community has to fall into that LMI category in order to meet or qualify for their funding. With USDA and the State Revolving Loan Fund, most of those use household income, and they also use, they do not use the number of people. So it's not as beneficial to obtain the number of people in the home unless you're doing CDBG. We collect the data just in case we want to utilize the data for another funding, another funder if we can use the same data. So when we conduct income surveys in California, or RCAC conducts them in the Western states, we typically are going to ask for the number of people that are in the home. They're going to ask if you are the primary residence, do you live there 6 months out of the year? And they're going to ask for income of any person living within the home of 15 years of age or older that's receiving any type of a regular income has to be included. So that means even those people that are on public assistance, alimony, child support, any of that type of is considered income. And you have to count that as the household income. And then once you've determined what the guidelines are and what you have to do, next is to proceed to develop a plan on how you're going to conduct the actual income survey. So we have another poll. So who can conduct a qualified survey? Would that be utility staff, the engineering firm working on the project, an outside third-party contractor, or a committee formed by the community?
And we will leave this poll open for just a few more moments here. And getting ready to close in 3, 2, 1. So Jean, 60% of attendees have selected an outside third-party contract. Next, coming in at 20% is a committee formed by the community. 11% have answered utility staff, and 9% have answered engineering firm.
Okay, there's no right answer to that. It's kind of a trick question. It really boils down to what the guidelines state. And if the guidelines state it has to be an outside third party, then you need to contract with an outside third party to conduct it. And what I have found, USDA does require an unbiased outside third party. Most of the state revolving loan fund programs also require an outside third party that's not invested in the project. So in that case, they would not be able to use an engineer or a committee formed by the community. There are some funding agencies that will allow you to form a committee to conduct the income survey. And then I've had actual communities that have done one just to determine if they would even qualify. Rather than spending the money to contract with someone, they'll conduct one themselves first just to see where they're going to fall out and if it's actual worthy. Because once you conduct an income survey, you have to utilize that data. The funding agency, and that's another reason why they want to approve to have you having an income survey performed, because once you perform the income survey, whatever the outcome is, be positive or negative, you are stuck with that information or that data for the next 5 years. And that can be beneficial or not beneficial. That's why I say you really have to know your community and know that you're going to fall into a lower median household income or a lower LMI than what the actual census data is going to. Because it could be a double-edged sword and you're stuck with that data or those results for 5 years once a survey is actually conducted. Any other questions out there before I move on?
Yeah, so we have a quick clarification from a question that I asked earlier. So The attendee has asked, you have explained that there's a national norm that 1.5% of a community's median household income is considered an affordable rate to pay for the water services in disadvantaged communities.
That's correct. They're looking at anywhere to 3 to 4% if you're not a disadvantaged community.
Okay, so yes, she was just asking if there's a similar standards for affordability for wastewater services that are tied to median household incomes.
Yes, yes, they use the same for wastewater projects as well as drinking water projects.
Perfect. And then another question that we received is what level of usage is used for the MHI calculation?
Don't understand what they're asking. They
We
can
will,
clarify.
perfect. Let me just give me one moment here, see if, okay. So what level of water usage is used for the MHI calculation?
Don't use it at all. We don't use anything. What we're doing is we're actually surveying the permanent residents within the service area's income. So we're asking them what their gross household income is of those living within that are permanent residents within that residential unit. So it's the same thing when you come to apartment complex. When we're conducting an income survey, we have to know the addresses for every residential unit within the service area. So if there's apartment complexes or duplexes, we need to survey every single person. So the amount of water usage has nothing to do with your funding or meeting the funding criteria or to determine if you're a disadvantaged community or not. We're looking at just the household income of those permanent residents within the service area. And they, in most guidelines, and they're different for different funders, but typically the smaller the service area, the higher the response rate needs to be. So if you have a community of under 50 connections, they're going to require a 90% response rate to determine what that median household income is, or the LMI. The larger the community gets, the lower the response rate that you have to meet to qualify the income survey. And then with the COVID-19, it's been very difficult because I find I've done over 250 income surveys in the last 10 years. And it's always been a case with a small system that it never fails that we have to go out and actually conduct a door-to-door survey to collect enough responses to qualify the survey. With COVID-19, what we're struggling with is we can't conduct those door-to-door surveys. Surveys are taking much longer to meet those response rates, especially at the smaller they are. As they get a little larger, it goes into 83%, then it could be 80%, and it gets lower and lower. When you get up into, I want to say, up at about 1,300 connections, then it gets down to like 13% response rate. Typically doesn't require a door-to-door survey. And COVID-19 dates, in this environment today, it's easier to conduct an income survey for a larger community than it is for a smaller community. So what we've done to mitigate that is it requires that you have either email addresses or phone numbers of all your customers so that we can contact them. And conducting an income survey, it requires, unless you're surveying a larger community, I'm trying to think, but typically it's over, I think it's 3,000 in California. If you serve over 3,000 residential units, then we go into what we call random selection. We'll actually take all the addresses, set them up in blocks, and then randomize and select a percentage of them to actually conduct the survey. So we wouldn't conduct a survey on 3,000 residential units. We'd only do that on a proportion of the actual community, and then meet the response rate required for that. Those selected in the random selection to actually survey. So for the smaller systems, now we're requiring even to take on or to conduct an income survey that you have at least phone numbers or email addresses, because we have to survey everyone within the community. We cannot can't just contact one or two or three on the list that haven't responded. We have to contact all of them so it doesn't appear that we're only selecting those that may be of lower income and trying to collect just the income of the lower income residential residents and customers, that we're actually fairly collecting the data from randomly throughout the community.
Thanks, Jean. And lastly, an attendee asked, is it gross annual income or adjusted gross income that you're collecting data on?
We're looking at gross income unless you have a private business. If you're a private business, it would be on net income for that year. Good question. But if not, they're looking at actual gross income. And any income that comes in on a regular basis, like I stated, if it's public assistance or if it's alimony, child support, whatever that may be, if it's regular income, pension that's coming in on a regular basis, that income needs to be included.
Great. We're receiving a ton of questions, so I just want to also make everybody aware on the call that in case we do run out of time here, we will be able to follow up with you after this broadcast. I'm just going to keep reading a few off to you, Jean.
Go ahead, because we've only got one more, couple more slides left, so we're doing well.
Perfect. So an attendee asked, what level of reserve do lenders look for?
Really, that's, again, they're looking at the median household income and where your current service rates are and what you currently have in reserves. I mean, they're going to look at, they're trying to provide you the least amount of grant funding that they can possibly provide you. That the grant funding is set aside for those severely disadvantaged or disadvantaged communities. So they want to make sure that they're not giving it to a community just to keep their water rates low. So you may be a disadvantaged community, but your rates are really low, and they're looking at that and they're like, no, we're not going to provide you grant funding. Although you're a disadvantaged community, we're not going to provide you grant funding because your rates can be increased to pay for debt or to pay for a portion of the project. So it doesn't benefit you by not increasing the rates. Like I say, it gives you the ability in your capital improvement plan and designing your asset management plan is to look at that and say, okay, 5 years, 10 years down the road, whenever your project's going to need to be constructed, how much can we, if we increase rates gradually over time to get them to that 1.5% of the median household income, how much reserve funds is that going to be set aside that we can actually, and that money again is, you know, less money, the less amount that you have to obtain in debt, the less costly the project's going to be. So we're trying to do whatever we can in order to not take on debt. And the funder's looking on if you have the ability to take on debt. So in your planning stage of your capital improvement plan, you want to start looking at that rate and that 1.5% if you are a DAC, and starting to increase those rates and start developing, setting that money into the reserves, because that's going to help you to be able to qualify for grant funding. So if they say that you've raised your rates to that 1.5%, that's what they're looking at. You're up at that level already, okay? And now you've got, okay, this amount set in reserves that you can put towards the project. And then they're going to say, okay, to complete the project, we need this much grant funds because their rates are already at the highest affordable rate for their customers. So that makes you eligible for grant funding or higher amount of grant funding because you're already at that level. If not, they're going to look at, they're going to want you to increase your rates and pay for a portion of debt. They may give you a portion of grant funding, but they're also going to look at you, forcing you to increase your rates to take on the debt because you can afford it. If you can't afford it because your rates are already up there, yeah, we do have some reserves, but that's not going to pay for the infrastructure project that we're needing to pay for. They're going to then say, okay, well, you qualify, we can give you 100% grant to be able to pay it. They, you know, again, when I went to up on the Hill in Congress, you know, DC, the congressmen are saying, you know, they want communities to have buy-in. And when they see that you've done your due diligence to raise those rates and set aside as much as you can to help pay for the project, you have buy-in. You're buying into the project. You're planning appropriately. You're managing yourselves appropriately. And they take kindly to that. They see that you've done everything you can to collect as much revenue as you can to pay for that project that's affordable for your customers. If you haven't done that, then they're going to look at how can you do that. Okay, well, we can get them to increase rates to this level, and we can provide them this much funding in the way of maybe zero interest loan to make it affordable, or can we stretch the loan out 40 years instead of 30 years to make it affordable? I mean, they're going to look at all angles that they can possibly do to make it affordable to your customers. So it's, again, it's looking and planning yourself to develop those reserves based upon what's affordable to your customers is going to help you to qualify for more grant funding. If not, they're going to force you to do it.
Thank you, Jean. An attendee asked, why is MHI used over median family income?
That's just the national guideline standards for USDA and most of your state revolving loan funds is to use household income. CDBG is a different federal agency, and they've just decided in their guidelines, and their guidelines are very complicated, as well as their methodology for CDBG. But that's just that funding agency's guidance. That's what they require, is that you look at the family's income within a household instead of actual household income. But you can meet both guidelines and conduct just one survey in doing that. You just have to, what we do is we state on the survey form, ask the question, is there an additional family, more than one family living in the home? And if there is, please contact us in order to obtain an additional survey form for the other families within the home to complete. And then what we do is if there's more than one family in a home and we're looking at USDA funding and meeting their criteria, we just add up what the income is total for that household to meet their requirements. And then we break it up for CDBG. So we'll have totally two different results, reports for the different funding agencies, but it can be done together.
Great. And then an attendee asked, for non-disadvantaged communities that have the 3 to 4% MHI, has that been politically palatable? What's the highest annual rate that you've been seeing charged?
I've actually have a customer, a community of 80 homes that are paying $400 a month. And because of the type of entity they are, they don't qualify for federal or state funding. So that's why I say you really have to look at your structure of your community. If you're a privately owned system and you're for profit, it's difficult to get funding. You're not going to get grant funding, that's for sure. If you're a private nonprofit type of entity, then you're eligible. You can be eligible for grant funding.
Great. And then lastly, more of a general broad question, but as you're doing these surveys, what prevents a citizen from lying on the survey?
That's a good question. I've actually had a community's income survey disqualified because they sent out a letter to all the customers explaining to them that they have to, in order to get, be able to get these grant funding we need for a project, we need to meet both, our income level, median household income level has to be below this level. So we're really looking for any of those folks that are, have a household income of this level or below this level. We really need you to respond to the survey. That's going to disqualify you. Any public outreach that you do, you have to be very, very careful not to encourage people to indicate a lower income than what's their actual median household income. The other thing they're going to look at, historical data, and if it's really off from historically what your community's median household income has been in the past, they could disqualify it. And that's a lot of reasons why they ask that an outside unbiased party actually conduct the income survey. So there's not any they have no connection to the project or the community. Also, it keeps all these, typically the survey is conducted to be confidential, and they want to make sure that confidentiality is followed through with. And I know we're getting up on the top. We're on the top of the hour. I got one more slide real quick here. Who pays for the income survey, I think, is critical. Check with your technical assistance providers, if that be EFCN network, or if it's RCAP networks, or we've got also the Rural Water National technical assistance providers out there. Check with them. A lot of them have funding. They have funders that will pay for the cost of the income survey. So if you're applying for USDA rural development funding, I recommend that you contact your technical assistance providers, either Rural Water or RCAP, whoever your preference is, and ask them if they conduct median household incomes surveys, and if your community meets the criteria for their funding agency, because both agencies receive funding from USDA to provide technical assistance, and part of that is to conduct an income survey. And if that's the case, that funding agency will actually pay for the full cost of the income survey, and it's no cost to your community at all. You can check with your funding agencies. I find on the wastewater in California, under our SRF funding agency or funding program for wastewater systems, they will not conduct the income survey or pay for the cost up front for the income survey, but it is at a reimbursable expense once you've obtained the funding. So your community can actually get reimbursed for it, but I always ask the funding agency if it is a reimbursable expense. And then in California, the State Revolving Loan Fund Agency, which is a state water resource control board in California, actually we have a contract with them, so they also will pay for a median household income survey. You can check with some of your local universities. A lot of them are willing to provide volunteer students to conduct the income survey at no cost to you. If not, you can look at different contract with a reliable, impartial source. We conduct them if it doesn't fit under our actual funding programs to conduct it at no cost to the community. Then we do contract with communities to do it as a fee for service. So this is our Rural Community Assistance Partnership. As you can see, we've got different agencies. Same thing with Rural Water. They've got, each state has their own Rural Water Association, and then also the EFC network also has our nationwide. Those are your key technical assistance providers that you can contact, and should be typically are knowledgeable of income surveys and those requirements, and typically can conduct them as well. And we are at the tail end to questions and answers. Thank you so much. We kind of a little bit over there, but if there are any other questions, I'd be more than happy to stay on for a couple more minutes and answer those, Savannah.
Thanks, Jean. I have not received any questions from folks as of right now, but I do have one more poll question to follow up with your technical service assistance that is available through multiple programs. But if you're interested in hearing more about what the EFCN might be able to offer you in relation to the topic that we discussed today or beyond, please let us know here and we can follow up with you. And I'm just going to leave this open for just a few more moments.
And thank you all for attending the session today and all of the great questions. Great participation. And Savannah, thank you so much. You did an awesome job on setting up all those polls for me as well. And
thank you so much, Jean. I'm going to close this poll right now. And I would also like to definitely thank you for providing your expertise today for the session. There was quite a bit of dialogue that went on the back end, and we'll definitely be sharing that with you. You can follow up as you feel needed. Thank you, everyone, for joining us today. And, Jean, I send it back over to you for any last closing comments.
Yeah, I guess my comments to you is, if you want a strong capital improvement plan and asset management plan, talk to the funders sooner than later. know what the criteria is, and follow your census data, because that's critical in being able to obtain that grant funding that you may very much so deserve as a community. And then you've got my email address as well. Anybody, you're more than welcome. If you have additional questions and want to shoot me an email, I'll be happy to answer any additional questions as well.
Great. Thank you so much, Jean. Have a great afternoon, and everyone else, enjoy the rest of your day.
Thank you.